This is Ben Woodhams. I'm the Managing Director of Knight Frank Kenya, and I'm hosting the next panel. I think I'll just wait for some of the other panelists to join us. Fia, is that okay? Are people on their way into this room? Gerhard, welcome. Can you hear me okay?
Yes, thank you.
Excellent. Okay, I think we'll just wait for the other panelists to join us, and then we'll kick off in a few minutes.
Yes, that's perfect. So yeah, we'll just wait. I think the rest of the panel are joining us now, and then we can move directly into the session. Yeah, that's perfect. I think they'll be joining in as we speak. So as soon as they join in, we can get going.
Okay.
So that's perfect. Thank you, Ben. Thank you, Gerhard.
Sure.
Hi. Hello.
Hi, Tim. How are you doing?
Fine.
That's great. I think we're just waiting for James McLean, and then we'll be good to go.
Great.
Okay, so Kafir has asked me to begin. James will be joining us shortly. So, as I said, my name is Ben Woodhams. I don't know if you managed to catch my presentation earlier, but I'm the Managing Director of Knight Frank in Kenya. And this session is a panel session, and we will be talking about the topic given to us by API is thinking differently and strategizing in a changing market. So prior to COVID-19, the market was already experiencing a slowdown. So what strategies are in place to revive the market? What has the pandemic taught us? And what can be done to rebuild a resilient market? So we're looking today at solutions and new strategies for market correction. So I have with me Gerhard Zili, who's the head of Property Finance Africa for Nedbank in South Africa. And I have Theodoros Pantis, who's the managing director of Centum's flagship project, Two Rivers Mall in Nairobi. And we are hoping that James McLean will be joining us. James is a director of real estate at Fusion Capital. So I think just to sort of set the scene, have a broad update, I have some questions that have been provided by EAPI, and I think we'll start with those. So filling up vacancies, dealing with tenant renegotiations and selling unit strategies for a tough trading climate. I think Theodoros, this has got your name written all over it, this question, with Two Rivers, that certainly the retail element of it, filling up vacancies, dealing with tenant renegotiations. Why don't we start there? What is, James has joined us. Welcome, James. Great to have you here. I'm just taking my first question to Theodoros.
Sorry about that.
That's quite all right. Welcome aboard. Filling up vacancies, dealing with tenant renegotiations, Theodoros. I'm sure you've had a few tricky conversations with your tenants. I know that I have in some of the malls that we manage. Why don't you give us a little bit of an update as to how that's been going?
Thank you, Ben. Thank you, Ben, for this opportunity, and thank you for also for this question. I think this is a very accurate question, especially during the pandemic environment. Yes, indeed, we had a lot of difficult discussions with our tenants the last 3-4 months. But let me give you my perspective. I think in general we need to rethink, and we need to deal with our retailers, with our tenants in a different way. And we need also to find solutions. We need to find solutions, not the ordinary solutions. It was in the past very, very easy and very, very simple to attract H&M, to attract Zara, to attract local retailers, especially in big iconic projects like Two Rivers. Right now, you need to convince them why they should enter to the shopping center, or why they should keep be operating in the shopping center. Taking into consideration, and I spoke also with the Shopping Center Association in Kenya, that almost the last 3 months, 50% of the footfall was disappeared. So we need to rethink our strategies, and we need to capitalize on ideas like, for example, how we can utilize pop-up stores, how we can use, for example, gyms, how we can use, for example, co-working spaces, how we can use, for example, this is also very accurate right now, escape rooms, or if you allow me, we need to look for tenants from the so-called 5 Fs, retail, fashion, fitness, food, fun, and furniture, in order to maybe to find solutions to our vacancies. Right now, we need to balance out as a shopping center, and I can speak also for the shopping centers in Nairobi, because I'm representing right now the biggest shopping center in West East Africa. We need to balance out occupancy with financial performance, and this is one tricky element, how you manage to keep your occupancy, and from the other hand, to keep a financial freedom in your P&L. The last 4 months, it was a very hard exercise in order to keep both rates on a high level. And yes, we gave also discounts. We turned also our rent structure and lease structure we connected them to turnover rent. We gave also rent discounts to our tenants, but we need to think how we also approaching to our tenants, the existing tenants, and we maintain current occupancy levels. How is our marketing strategy? How we are approaching and we are improving our marketing product? How do we create, for example, e-commerce strategies in order to attract and improve their sales within this pandemic environment? So there exists a lot of thought and thinking behind all these elements. And to close also my section, yes, it was a tough period. We need to rethink. It's not easy to attract any more international tenants. As far as you know, also international tenants are closing their shops worldwide, taking H&M, Zara, etc. A lot of first caliber retailers are not expanding anymore. LC Waikiki, for example, is closing completely, shutting down completely their business in South Africa. So you need to stimulate your tenants in order to keep them alive. And regarding the vacancies, yes, you need to rethink from pop-up stores to new ideas in order to present your shopping center or your office buildings on a level that is appreciated from the visitors. The last thing that you can afford is having visitors within your shopping center and each second, third shop to be empty. This is a very, very bad perception that they're receiving, and they should be, at least what I'm saying with my team and what we're discussing internally, we should avoid it in any case.
No, I think that's absolutely right. Yeah. Thank you, Theodoros. I think that's absolutely right. And in our experience, certainly across East Africa, where we're managing shopping centres, landlords would have the ability to say, okay, you haven't paid your rent. We're going to take steps to recover that rent. But they are fortunately more sensible than that, and they understand, as you said, you need to stimulate tenants to keep them alive. I think that was a very important point you made there. The landlords know that they have to look beyond the terms of the lease and actually have sensible conversations with their tenants to keep them alive. And the tenants have to also understand that landlords have their own financial obligations as well, and so it goes beyond a landlord and tenant negotiation. It's also landlord financier negotiations that are ongoing as well, and so there's a whole chain of understanding that is happening, and we're seeing a lot of tenants wanting to switch to turnover models. There's a phrase that's been bandied about quite a lot recently about sharing the pain. This isn't a problem that is of the creation of either the landlord or the tenant, and so both landlord and tenant need to share that burden and negotiate to a point where let's come to an understanding where we can get as close as we can to both parties surviving and having a future when we come out of the situation at the end of the day. I think that's really what you're saying, Theodoros. Is it?
Yes, Ben, if you allow only one sentence, I think, yes, we need to with our tenants and between tenants and landlords, we need to have a common denominator. And I think starting in late March, in the beginning of April, it was very, very hard to find this common denominator. And after 4 months experience, I can say with confidence, at least for Two Rivers, yes, definitely we have found this common denominator between our tenants and ourselves. Definitely they need to pay service charges. This is one of the main obligations they need to apply in order to keep the shopping center alive. Apart from the service charges, yes, apart from the service charges,
I think carry on.
Apart from the service charges, yes, we need to find also a common ground on the rent. There exist different models on rent, but beyond that, the landlord or the property management company, they need to rethink how they attract new tenants under the pandemic environment. I can say right now that during the pandemic environment, we have closed 3-4 big tenants. We could win 3-4 big tenants for the shopping center. But you need to think out of the box in order to convince these tenants to enter to your shopping center. And you need to share the broader vision. You need to share with them the perspective in entering in a property. And this is exactly the marketing team that is entering inside. And I'm not convinced, to be honest, that each marketing team is sufficient equipment in order to overcome the situation. We need modern tools in order to convince right now a potential tenant to enter to a shopping destination. And I would like also to say to the rest that are listening to us that marketing is playing a critical role. If marketing space in order to create out of the box thinking in order to attract current needs and future needs. To speak the language pre-pandemic, it's not any more accurate.
No, I agree, and obviously being in retail, Theodoros, you're at the coalface here. You're in one of the sectors that has been most badly hit. If we can move away from retail just for a moment, and Gerhard, if I could ask you, we're seeing the problems that developers and landlords are facing, negotiating with their tenants, really trying to get to a situation where they can both agree terms to get out of this extraordinary situation. Presumably, from a developer's perspective, we touched on developers having similar conversations with their financiers that tenants are with their landlords. Looking to the future, and of course we must look to the future, we must look beyond this situation. The wheels keep turning. are developers proceeding with projects now in the knowledge that by the time those projects are completed, the market will be ready for them? Or are they simply putting everything on hold indefinitely? I mean, how forward thinking are developers being with a view to this situation? Do they see the light at the end of the tunnel, or have they simply shut down completely?
The general trend, I think, is for developers to say, let's just sit on our hands for the moment. Not just because of uncertainty around, how quickly things would turn around, but also uncertainty in respect of how assets in the different subsectors like retail and hotels and residential even, how those should be replanned for a post-COVID operating environment. So even if things return to a new normal, I think we will still operate a lot differently from the way we operated pre-COVID. And I think that's very wise. I think to push ahead with a project in the hope that things will look a lot different in 2021 or even 2022 is dangerous. There are certain subsectors, particularly the residential sector, where, apart from the fact that residential properties might look a little bit different in that they would not only be places for staying, but also places for working or even educating your kids or maybe running small businesses from, etc. I think residential property will probably be more or less the same in a post-COVID environment. And we are seeing some clients moving forward with residential projects, but the rest pretty much on hold.
Okay, yeah, fine, understood. I mean, it's understandable, really. There are other sectors to be considered, presumably, such as healthcare, student housing, and so on and so forth. But one can understand, obviously, in the eye of the storm, particularly in South Africa, where a lot of the development muscle comes from across the continent, that we wouldn't be expecting developers to be making some plans going into the future quite at this stage yet.
Sorry, Ben, on that, I think that comment pertains to the whole continent, not only South Africa or East Africa, but we're seeing that as a general sort of position that developers are taking at the moment.
Sure, absolutely. No, I understand. James, Director of Real Estate Fusion Capital. So you, even before pre-COVID, Fusion has been talking about repositioning strategies for some time. So do you think the pandemic will increase the availability of these kinds of opportunities? I mean, are there opportunities out there that the pandemic has created for cash-rich organizations to take advantage of, or are there other ways of looking at this pandemic than simply battening down the hatches and waiting for it to be over? What are your thoughts?
Yeah, so thanks. I'm sorry I was a little bit late to the meeting. Yeah, I think we trained our team. We actually partnered with a UK mid-cap turnaround real estate investor about 2 years ago and trained some of our team in it, and then came back to Kenya, buoyed with confidence, and East Africa, looking to do deals. But we just found that unrealistic valuations and the perception of the capital market still being vibrant led to really not being able to do deals on terms that were commercial for someone bringing capital in. So I think we're relatively confident that this further, it's no secret the market was in decline before, pre-COVID, and we think that there's more likely that people will be willing to come to the table with an experienced developer who has some capital behind them. People will be willing to come to the table to reposition assets. But like I say, up until this point, we've bid for a couple, we've put in proposals for a couple, and not, and people have just expected the cash will come back and have been willing to sit on non-performing assets. I think it was already a trend that people were starting to wake up to and I think this will just exacerbate that.
Okay, interesting. Interesting point you make about people still holding on to the values pre-COVID and not being prepared to adjust those values to a more realistic level, presumably in light of yields changing as perhaps income streams have changed in the short term and look a little less certain in the long term. Gerhard, what do you think about dealing with price? Do you think that valuers will start to have a more realistic approach, or do you think that they're still clinging on to, I suppose in a sense, being afraid to open Pandora's box where we start seeing big value changes across the sectors in the market?
I must be honest, I don't see why we are all afraid of value changes in the property sector at this point in time. I mean, look at the various security exchanges. There's been a repricing of assets across the globe, from equity instruments to bonds, debt instruments, and very much the same applies to property valuations and the value of property valuations. And I agree with the point around property valuations that were probably a little bit rich even pre-COVID, and sort of the result of COVID has been sort of a higher impact on valuations in a very, very short period of time. I must be honest with you, Ben, there was a portion of your question that I actually missed. I don't know whether you were talking about distressed properties as well, or just the valuation of assets.
No, I think it was really in the context of James at Fusion Capital looking for opportunities that COVID had presented and finding that owners of those assets were reluctant to adjust their pricing as a result of what's happened, and whether you felt that those changes must take place. And I guess it then leads on to assets becoming distressed and the opportunities there. So perhaps you could talk about those as well.
I think the first question in that whole sort of scenario of distressed assets is, why is an asset distressed? Obviously, all the assets across all the subsectors, their cash flows have been severely impacted. But an asset can be stressed because of the outlook of that asset, and how one sort of sees the asset potentially recovering post-COVID, or an asset can be distressed at a point in time, mainly because of its capital structure. And if that capital structure has got a large layer of debt, and specifically inflexible debt, or debt with certain triggers in respect of the performance of the asset, one might land in a position where the asset is termed distressed, but it's actually as a result of the capital structure. We see a lot of clients focusing on that capital structure at the moment to say, or to think about an asset in a post-COVID environment where the asset is seen to be still in a position to be a retail center or an office building or a industrial site post-COVID, in which case these clients are more focusing on restructuring the capital structure, maybe putting in more equity or renegotiating with their financiers to have a more flexible debt structure. And that's fine. And we obviously they need to see how that all pans out post-COVID. I think where property investors are being honest with themselves and looking at a particular asset and saying, listen, this asset, already pre-COVID wasn't performing well and is now performing terribly, and the outlook on this asset, even post-COVID, is also not great. I think there the answer is quite simple, in that this asset is not going to work. And unfortunately, there are some of these assets around, and a lot of people have been talking around repurposing assets and turning assets and office building into a residential development, all of that. And it sounds like a great plan, but as soon as you start writing a spreadsheet on these proposed redevelopments, you'll see that actually the current value of that asset, after you take, obviously you need to take a different sort of cash flow stream post redevelopment into account. Typically, a residential cash flow stream is a lot less than an office cash flow stream. When you present value that residential cash flow stream and you deduct the cost of repurposing or redevelopment, you'll see that in most instances that asset is actually worth a negative number. So whoever should give you that asset should actually pay you to take it over, or at least give it to you for free. So I'm very curious to see how this whole repurposing argument or repurposing plan around assets that cannot perform in their current shape post-COVID is going to pan out, because I must be honest, I think that it's going to be very, very difficult to make those numbers work, and I would love to hear what James thinks about that as well.
James, there you go.
I think,
what are your thoughts?
Yeah, I mean, we're the way we approached this pre-COVID was that it's not that it's assets literally are empty. There are buildings at 40%, at 30%, where people still, we bid for a building that had no tenants, and they wanted the reinsurance value for it, and the insurance value for the building, which was how much concrete they put in the ground, and that's just not the value of that building. But we could have repurposed it really easily and made a vibrant, product, and they would have made, compared to the yield, which at the time was 0, it would work for them. So I'm talking about areas, and I think I don't think we can hide from the fact that Nairobi has loads of huge residential buildings and mid-sized office buildings that have 30%, 40% tenancy. I think that's where people will start. I think everyone's been kind of holding on for the recovery, and but instead of seeing the recovery, which let's be honest, if you can cast your mind back the millennia to December 2019. Which obviously feels like forever ago, we were all saying the market's going to open up because there'll be more capital coming in once because of the repealing the rate caps. Everyone was holding on and hoping that they would get some sort of recovery, as opposed to actively looking at their buildings and figuring out what to do with them. So that's our view is that COVID might have just pushed those people over the edge, and we are starting to see more investor-led approaches or opportunities where they're sick of there being no return or no sale or no yield, and they're looking for someone to come in and either produce something which will produce an income because they're bored of not having any income, and they're aware that the way to do that in a saturated market is to change what you've got. It's like I say, it's something we think will become more important, but it really isn't a market yet in Nairobi and in East Africa.
Yeah, no, I agree. Theo, you've made a comment earlier on your thoughts about lack of project finance. We've talked about project financing. I mean, with a decline in project financing, how do you think developers and investors will adjust their strategies, and what are your thoughts on what's been discussed so far?
Yes, but before answering this question, let me answer also to James. There exist also reliable developers in Kenya, and I can tell you about my project. We are doing property evaluation almost twice per year, at least once per year, in order to see and evaluate the value. And we would like to attract investors, either equity investors or to use other financial instruments in order to attract investors, having a very, very short, mid, and long-term planning. And our long-term planning is going up to 10 years. So we are very open book to our potential equity investors in general, in order to discuss. So there exists reliable investments, reliable investors in Kenya. We are currently developing under COVID the expansion of Two Rivers with 4,000 additional apartments. So we're expanding our residential business. We are building the biggest cinema and bowling facilities in Nairobi, in Southeast Africa. again with the help of investors and third-party investors. So we exist professional companies that are working with and using modern tools in order to convince investors, in order to put their money and raise capital or adapt our vision for long-term earnings. So this is at least so for James. So we can speak also later if you like, in order to see the opportunity to discuss the opportunity for Two Rivers.
I think you might pay the API commission for any deals that you do in this forum.
That's also an opportunity. Sorry, Ben. That's also an opportunity to discuss and find common ground and find common ground.
Absolutely.
Yes.
Absolutely.
Sorry. Can you repeat? Yes. Can you repeat once again your question?
Yeah. No, it was about the lack of project finance and whether the decline in project financing will change how developers and investors adjust their strategies.
Yes. It's we can discuss about this the next half an hour or until the end of the session. Definitely they will adopt the strategy. Right now, under COVID environment, it is very, very tough to convince investors in order to commit on specific funding or to adapt your short-term and mid-term vision. So this is something that I think it's also for the future. It's we need to adapt ourselves. I would like to speak right now as a landlord, and how we approaching this in order to convince potential equity investors in order to jump in our vision. For us, it's very, 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 very important to be transparent, to share our short-term, mid, long plans with the potential investors. I'm discussing right now with three, four big funds, two of them from the Middle East, to invest not only in Two Rivers but also in projects in Mombasa and in Mombasa, the current development, the Pingo development that we are leading, plus in Uganda. But you see, it needs much more effort. It's harder to convince them. You need to present the long-term strategy, the yields, the perspective. It's you need to present also that you have enough cash flow to that you can continue to construct either the shopping center or the residential or office complexes. So you need to present also. You need to prove that you have sufficient funds, self funds, in order to proceed with that. So it is a very, very tough situation right now, and I think everybody's on a reserve mode. It's on a defensive mode. They don't want to have aggressive takeover or aggressive stake takeovers from companies. They would like to see after, at least this is my point of view, they would like to see after post-COVID where the market will land in order to continue their investment, at least in Kenya and surrounding markets. That's from my end. Okay,
fair enough. Thank you for that. A couple of questions coming in from API. One for you, James. Which asset class do you think has proven most resilient in this pandemic? Or to ask a question slightly differently, do we think any sectors have been affected less? I mean, I know I've got my own opinions on this by the pandemic. Which have proved to be more resilient in your eyes?
Yeah, I think you mentioned the key ones that stand out. I think warehousing obviously is still doing quite well. Data centers and self-storage. Self-storage not a big thing yet in our market, but people have started moving into it. I think that's done quite well. Obviously, it's hard to tell what's going well unless you're doing it yourself. So I'd say the only thing, the one thing we're the kind of shining light in our portfolio at the moment is low income rental. You know, we've been looking at that space pretty heavily. I think low income sales has been struggling just because there's not enough money in the market. But I think we're pretty bullish on low income rentals, just because it's where the market is. It's where the market everyone talks about. It actually sits. People with less than $500 who want to spend less than $250 on their apartment. So we think that's one area where, when people start having less income, you get downward pressure into it while people move out of it. So that's one area where we're still pretty bullish, and actually still putting a lot of time into during the pandemic.
Okay, great. Gerhard, one for you. We've been seeing rental concessions and rent holidays in the East African market during this pandemic. And do you think that levels of rental concessions and holidays will increase? And will we see further softening of those as we go through the cycle?
That's a difficult question. I must tell you, I do think we probably haven't seen the end of rental concessions and tenants battling. COVID, we might in a lot of countries be approaching the midway through the COVID crisis, or in some sort of heading towards the midway of the crisis. But the thing for me that remains a little bit difficult to gauge is how potentially people's behavior would change post-COVID. So it's not just to get through COVID and then everything is the way it used to be. It's to get through COVID, and then how will people behave post that? And on that, I do think for a while people are going to be a lot more careful in terms of where they go, how they interact with other people potentially, and I think that's going to continue to have an adverse impact on rentals.
Yeah, no, I think that is a very good point.
Question,
yeah, sure, go ahead.
And I need also to add something.
James first, and then we'll come to you.
Are you, to both Theodoros and Gerhard, are you finding that people are focusing, when we talk about these concessions, do you find that the guys you're in negotiations with are focusing on, say, the next 3 months, next 6 months, or are you finding people coming, with, say, 2 or 3 years left on their leases, coming and negotiating? How do you find your tenants are?
We're to speak from my friend, we're finding both extremes. So landlords are saying we'll give you a discount for this month now, and some tenants are saying we want to totally re-gear our lease and change it to a turnover model. That's certainly, so we're seeing both extremes. I don't know, Gerhard, is that the same in your experience?
So obviously what we're seeing is what our clients are seeing. So, and typically our clients, I think when this started off, our clients were accommodating to all tenants to say, listen, 2 months or whatever, because nobody knew exactly how long they could last. And I think everybody was comfortable to say, listen, let's share the pain for the next 2 months, or, then let's see what it looks like. I think our clients are coming to a realization that, point one, certain tenants just will not be able to recover. That's one thing. But also, in terms of how their assets would look post-COVID, and I'm specifically talking about retail assets maybe, is that some tenants might just not be appropriate for that particular center in terms of how our clients want to position those assets post-COVID. In which case, I think at this point, they're saying to them, listen, unless you can pay so much, it might just not work out for us going forward. And I think that's quite wise, because to keep a tenant in place that you firstly not sure can make its repayment obligations when things are going to turn around, and which will not add value to your asset in terms of tenant mix post-COVID, just doesn't make sense. And I think a lot of effort has gone into sort of figuring that out, and then discussing that with financiers to say, listen, it is a bit of a restructure or re-look at this asset, and will you be accommodating from a capital structure perspective in seeing us through that.
No, I agree. Theo, over to you.
Yes,
You wanted to.
I agree also, yes, with you, Ben, and also with you, Gerhard. I think right now the majority of the assets, they are running to rent concessions, or they're giving to tenants rent reliefs, or maybe also holidays in order to overcome the situation. And James, yes, there exist two different approaches. Landlords would like to keep the period as less as possible. Tenants would like to keep the period as much as possible and to extend it in 2 to 3 years. That's the conflicting interest. But let's utilize also this opportunity. In my point of view, we can utilize this opportunity also to exist also tenants that they will not survive. So you should not insist to keep them alive. So you can utilize this opportunity in order to improve your brand and tenant mix. You need to think also for the future, how you can improve your brand and tenant mix in order to be updated, and utilize this opportunity in order to update your brand and tenant mix in the future. As well as, in my point of view, yes, I think there do not exist shopping center right now in Southeast Africa that's not giving any form of support to tenants, but this is not long-lasting. Landlords can't afford to keep these concessions or rent reliefs or holidays for a period more than 6-8 months. They need to fast overcome the situation. There is a lot of running expenses that are running parallel. So we will be, at least in Kenya, I see that by the end of the year, we need to be back to a normal and more stable environment.
Yeah, Theo, I think that's very important, and it's a theme that's coming out here quite strongly. Landlords have got some difficult decisions to make going forwards. In a market where tenants are in short supply, landlords are still going to have to make decisions where they say this tenant isn't ever going to recover, or this tenant is not a suitable tenant to be in the mall, and we're just going to have to be brave and let them go or get rid of them. And I think, you know, that is going to be a theme going forward, certainly. And I think, you know, we're all going to have to make some difficult decisions there.
Ben, only one sentence. Yeah. And suitable tenant is fitting in the brand and tenant mix, or he will not survive the pandemic. So you need to foresee also if he will survive or not. But also one of the exercises that we need to take into consideration.
And these are difficult decisions to make, where you don't necessarily have a queue of tenants ready to come in and fill the void that you're creating by getting rid of them. But you're not really helping anybody by keeping a tenant on who's building up a greater arrear than actually moving them out. So we are. I'm getting some messages from API that they'd like us to start drawing this to a close. So I'm going to just do a little bit of recap, and then I'm going to go round and give each of you just to have a closing statement to make. So Theo, what I've taken away from you, what you've said, those tenants that are important to you, you need to stimulate them to keep them alive, but obviously with a view to making sure that you've got the best centre going forwards. And as we said, some difficult decisions to make. James, you had mentioned that there are opportunities out there, but we're still a little bit early on in the game. Owners are still clinging to fairly unrealistic values, and we think that some fairly forward thinking is going to be required in the market before we start seeing these opportunities present themselves at realistic levels. Gerhard, you also mentioned rent concessions can only be a short-term fix. I know that in our retail portfolio, and we've focused quite a lot on retail, but obviously it's true of other sectors as well. But retail is the obvious one because it's in our face. And of course, you know, Theo, you're there at Two Rivers. You know, we're managing a bunch of other centres as well. Rental concessions can only be short term. We can't just keep saying 50% and just keep that going and going and going. We have to look at long-term solutions. And one of the long-term solutions may be switching to more turnover rentals. It's something that we see in East Africa is quite common with our anchor tenants, particularly those that have come in from outside Kenya, but less so with our other retailers, particularly the smaller local chains. But I think that we are going to have to see more of that. That will obviously de-risk the situation to some degree from the tenants, but also will force the landlords to get buy-in in maintaining turnover and footfall, rather than just simply getting the tenants to pay that rent. The other thing we touched on right at the end was some tenants may not be appropriate for that centre. I think we are looking at landlords making some decisions that may seem painful in the short term, but for the long term sustainability of their investments and their development, will need to do so. I'm just going to go around as I see you on my screen. So Gerhard, do you want to give us any closing remarks? I mean, you I think have been I wouldn't say pessimistic, but certainly the most realistic voice that we've had on this panel. And I'm a naturally optimistic person, and we need a balance, certainly. But I think you've given us some very realistic points of view to think about. Do you want to just sum up quickly your thoughts on this panel?
I think you've summed it up very well. But I think I maybe just want to react to one of the things that you've said in your summary, and that is moving towards turnover rentals. That's fine. I do think, however, financiers and specifically debt financiers will need to start rethinking how we fund these assets, because typically, debt financing is based on a sort of predictable type of income stream that you sort of apply a level of,
and you don't know what it's
and you don't know what that's going to be.
That.
So I think that's going to be something that we'll need to solve.
Challenge. Yeah. Okay. Fine. Theo, what wrapping up remarks from you?
Yes. Thank you, Ben. I think, yes, as I think everybody, the common denominator is right now that we are facing a very, very challenging period, and that we enter to unknown waters. But I think that exist the instruments, and in order to overcome the situation, especially the property management and shopping center business, I think this is an opportunity. It is also an opportunity for our shopping center in order to differentiate his product mix to the other shopping centers. And by the end of this route, only a few shopping centers will survive. This is my personal opinion. And if you can, if you be one of the one shopping centers that will be by the end of the route, then you will be one of the winners. But I would like to encourage everybody to think out of the box. We need to implement new ideas, ideas that in the past we will never implement. We will take it. We need to take it right now seriously into consideration. That's as my final remark. Thank you, Ben, for hosting this very, very interesting session.
Thank you.
Sorry, I didn't get you there, Ben.
Now, I was just saying, would you want to just have a final remark or wrapping up from you?
Yep. So I think the general feeling around the market is, and I'm copying Gerhard's words from a different panel I saw him on, it's still too early to tell where the opportunities are going to be, but a shake-up in the market does lead to opportunities, and I think we're starting to see where those opportunities might come out and planning for that. But we as far as we're concerned, we're still in the phase of consolidate what you've got, kind of plan for the future and clean up your current assets, but strategize and be ready for the opportunities, because they will be there, and you want to be with the right team, right space, and have some capital at that point. So I think that's it's not all doom and gloom. Obviously the pandemic is unprecedented and terrible, but when things shake, everything settles and opportunities will be available.
Understood. Okay, thank you very much for that. And thank you to my panel. Just remains me to say thanks very much for it. It was a fascinating discussion, certainly left me better educated, but possibly slightly less optimistic about the future going forward. Thank you for the API. Great discussion. Thank you for the questions from the audience. It's been great hosting this panel. I wish you all the best and stay safe. Thank you very much.
Thank you, Ben.
Great. Yeah, thanks, the API. Thanks everyone.
Thanks.